The US dollar may be our currency, but it is your problem. Those are the words that were famously said by then Secretary of the US Treasury, John Connally, back in the early 1970s after the United States had broken the Bretton Woods Agreement and had severed the tie of the US dollar to gold. And he said this to his global counterparts at a meeting in Rome, Italy, as they were very upset after the United States reneged on its commitment to exchange dollars for gold. But in many ways, John Connally was right. And at the time, the rest of the world had the choice to move on to another system, stop using the dollar, or perhaps even go back to gold themselves without the United States being involved. But they didn't. And the reason they didn't is because the dollar was their problem. And it wasn't as easy to do as they thought it might be. And as a result, they stayed with the dollar. And it is for that reason that the dollar is such a big part of my overall framework. In the 50 years since Connally first said those words, the dollar has not only remained a problem for the rest of the world, it has grown to be an exponentially bigger problem for the rest of the world. And I would argue that those words have never been truer than they are today. Now, you guys have heard me say for years now why the dollar is so important and why the rest of the world can't ignore it. But I've been talking about it even more recently for reasons that I didn't expect to be talking about it, and for reasons that I initially missed when I first took a look at this situation. And the situation is the proliferation and the growth of US dollar stablecoins. And the reason I probably missed it initially is because of the people involved in it, and the firms involved in it initially, I would say, had less than stellar reputations. But over time, more entrants have come in, and over time, the United States government, on an official basis, has, for the most part, blessed their existence. And that makes a huge, huge difference. And so I've talked a lot about US dollar stablecoins recently, and I'm going to talk even more about US dollar stablecoins in the future, because I think this is an incredibly big deal. And I think it is only going to get bigger and bigger. And so what we're going to do today is, I was recently at the New Orleans Investment Conference, where I gave an entire presentation on this topic. And so I'm going to play for you today the presentation that I gave. And this is kind of the presentation version of the report that we recently wrote on this topic. But the New Orleans Investment Conference, for those of you who don't know, it's a fantastic conference. And if you're trying to figure out, a conference to go to that has a plethora of speakers and some really good topics and just a lot of fun, this has quickly become one of my favorite conferences that I go to. So I would encourage you all to consider going. And I would also encourage you all to go to neworleansconference.com. And you can register. You can still register and see all of the presentations that are put online. So, I'm going to show you my presentation today, but there's a number of other great presentations that were at the conference. And as I said, I would encourage you to go to their site and sign up and watch some of them. But before I play the presentation, what I am going to do is I'm going to highlight some of the slides and a certain section of the presentation right now, because I think it's pretty important, because I think a lot of people, and I understand why they do it, because I initially did it as well. I understand why people initially think this is not a big deal and why they initially dismiss it. But I really think you got to take a closer look at this. And I think a lot of the arguments against US dollar stablecoins working are wrong. The arguments given why they will not work, I believe, are wrong. And so that's what I'm going to focus on right here at the beginning. I'm going to address a number of the arguments against US dollar stablecoins, and then that is going to lead into the presentation. So the main arguments that you get when you start talking about these are that, why would you want a US dollar stablecoin? Fiat, it's just another form of fiat. Fiat gets debased and the US dollar is losing purchasing power. Why would you want to hold this? That's one of the arguments. The other argument is that de-dollarization is underway and there is no longer global demand for US dollars. So the rest of the world is not going to hold these US dollars, regardless of whether it's physical cash, whether it's a checking account, whether it's a physical US dollar bill, or whether it's one of these stable coins. Another argument that is very popular is nobody will want them because they don't pay any interest. Why would you want to hold something that doesn't pay interest? The next argument is often the return of gold, and gold has had a fantastic year. Central banks are buying it. It is returning as the global reserve asset, and as a result, you don't need U.S. dollars. And then finally, the other argument is that other countries will launch their own stable coins, and that will deter or put a dampener on the rise of US dollar stable coins on a global basis. So let me just walk through these quickly. And I'm not going to spend a lot of time on each, but I'm just going to give you the quick answer to why each of these is wrong, basically. At the end of the day, the debasement of the US dollar, yes, that is true. Fiat currency gets debased. This is not a new discovery. Fiat currency is designed to lose value, and that is what it does. But this is not an argument for the US dollar competing with perfection. This is an argument for the US dollar competing with other fiat currencies. And the reality is, whether you like it or don't like it, I don't even necessarily like it, but whether you like it or not, the US dollar dominates all other fiat, and it sits at the global hierarchy of the financial pyramid of the monetary system. So the idea that the United States fiat is not going to be used, but these other currencies are going to be used, it's just silly to even entertain that idea, to be quite honest. So if you think all fiat is going away, that's a completely different argument than the dollar competing with other fiat. So that's number one. Number two is the whole de-dollarization narrative. The whole de-dollarization narrative is largely a mirage. Sure, it happens at the margins here or there, but on a systematic basis, the United States dollar has never been more important to the global economy than it is today. The United States dollar still greatly dominates all other fiat currencies and all other payment systems, et cetera, et cetera. And there's plenty of data to back this up. You might not like it, but this is just the way it is. The other argument is that they don't pay interest. Why would I want to hold on to something that doesn't pay interest? The ironic thing is I often hear this from people who are advocates of gold, which doesn't pay any interest, not typically anyway. There actually are ways to get gold to pay interest. One of them is monetary metals, which is one you've heard me talk about a lot of times. But in general, gold doesn't pay any interest. And as a result, people will say that's a reason not to own gold. But to give that a reason not to own the US dollar or not to own US dollar stablecoins, that doesn't make a lot of sense either, because most of the world's money doesn't earn a yield anyway, whether it's because it's in cash, whether it's because it's in a checking account, whether it's already in some kind of a form of digital or mobile money. And again, money is not necessarily supposed to hold its value or gain in value. That is not its function. The function is utility, not return. The reason we invest is because money or fiat currency doesn't hold value. But holding money and holding assets, again, these are two different things. You can make the argument that it's more important to hold an asset than hold money, and I won't argue too much with you. That's absolutely true. But these are two primary different roles. One is function and the other is return. And US dollar function is not return. The other thing is that the return of gold, right? And again, this gets back to this is not a store of value versus fiat currency argument. I think we all know that fiat currency is a bad store of value. And again, that is why we own assets. And the fact that gold has been rising versus US treasuries as a percent of central bank balance sheets is an indication of that they know this as well. And they don't want to necessarily hold on to all of their own fiat currencies. But again, this is a separate argument from the US dollar versus other fiat. And again, the US dollar versus other fiat, this is a game that has largely already been won. The final argument is that these other countries will launch their own stable coins. And as a result, there won't be any demand for US dollars. But this is kind of silly on the face because there's already huge demand for dollars outside the United States, even though there's other currencies outside the United States. And the simple fact is, out of all the stable coins that has been issued, 99% of them are in US dollars. And there are euro stablecoins, there are gold stablecoins, there are a number of different types of stablecoins out there, but 99% of them sit backed by US dollars. And this is not because the only US dollar stablecoins are offered. This is the market responding to demand. There is so much demand for US dollar stablecoins that is what the market provides. So this chart right here actually proves that there's more demand for US dollar stablecoins than there is for any other stablecoin. And it is on an order of magnitude so great, it's almost not even worth mentioning. Essentially, at the end of the day, all of these arguments are just really a strategic misunderstanding of what the competition is. And they all kind of share the same blind spot. They all assume that these US dollar stablecoins have to compete with perfection rather than competing with other weaknesses. And those other weaknesses are the other fiat currencies. The US dollar is not preferred because it's a great currency, and it's not preferred because it never depreciates. It's preferred because every other fiat alternative depreciates faster, collapses sooner, and settles less reliably. And this is the real foundation of that hierarchy pyramid that I showed you earlier, a system where power is relative, not absolute. And stablecoins extend that relatively into the digital domain. They make the hardest fiat in the world accessible to anyone with a phone, and it turns the dollar from a national instrument into a public good for the whole world. Where Americans see inflation, the rest of the world sees stability. And when the world votes with its savings, it still votes for the US dollar. And that is very easily backed up by data. So with that as the main arguments against why, it might come back to the arguments against why stable coins won't work. I'm now going to move into the presentation. But, again, we wrote a report on this that details all of this. If you go to santiagocapital.com, you can find this for sale on that site. You can also subscribe to our overall research if you go to research.santiagocapital.com. And again, I would encourage you guys all to go to neworleansconference.com and sign up and get some of the other presentations that were at the conference. It's a great conference, and I would encourage you all to go again next year. I'll be there, and it's always a lot of fun. And I think if you ask anybody else that's attended, they will tell you it's a lot of fun and a great learning experience as well. So with all that said, I'm going to now bring up the presentation. Hopefully I can figure out how to do this, and we'll go from there.
Our next speaker, as I said, is Brent Johnson. Following his talk, lunches will begin on the second floor. If you already have your ticket, please proceed. If not, you can always check in the rooms with the companies. There may be space available. After lunch, we'll meet back here at 1:45 p.m. to begin the afternoon programming. As always, please remember to bring your belongings with you. Forgot to make this announcement earlier, but if you were seated in the front row over here this morning and left something at your table, we have it for you. Just go down to the Main Street Media booth, and they have it for you. Okay. Our next speaker is Brent Johnson. Brent brings 25 years of experience in financial markets to his position as CEO of Santiago Capital, where he manages the portfolios of high net worth individuals and families via separate accounts and private funds. Brent enjoyed more than 9 years as a managing director at Baker Avenue, a $2 billion asset management manager and wealth management firm. Before joining Baker Avenue, Brent spent 9 years at Credit Suisse in the private client group. Guys, I don't know what pill Brent's been taking, but I'm pretty sure it makes you tall. So you might want to pay attention. His talk today is Our Currency, Your Problem. Please welcome Brent Johnson.
Albert. Hi, everyone. How's everybody doing? Good. I know I'm the one keeping you from lunch, so I'll try not to take up too much time. But first, I want to thank Brian and his team for inviting me here. This has become my favorite conference to come to each year, and I've seen many of you here before, so I appreciate you guys coming back. So, our currency, your problem, I think is a very apropos title for what I want to talk about today. As everybody knows, 2025 has been a year characterized by very large moves in both gold and the dollar. One of them lower and the other one much higher. And as I'm sure there's many gold proponents in the audience, I think you probably think that that's exactly the way it should be. Now, those of you who have never heard me speak before should know that I carry a somewhat controversial view regarding these two assets, and that is that de-dollarization is largely a myth. And I also think that despite all the dollar's faults, that it's not going to lose the global reserve currency status for a very long time. And perhaps more controversial than that is I don't think that that's necessarily bad for gold. And in fact, I can make a pretty good argument for why it's very good for gold. And in many ways, I see gold and dollars as complementary rather than as adversarial. But having said that, I do believe at times that each one can be a headwind for the other. And as such, I think it's kind of unwise to underestimate the power of each. And it's my opinion that people in the traditional financial world vastly underestimate the power and potential that gold could play in the years ahead. And simultaneously, I believe many in the gold world, vastly underestimate the staying power of fiat currency. And instead, year after year, predict the dollar's imminent demise. These arguments are not new. The same arguments of its inevitable demise have been around for 50 years since the United States first left the gold standard and broke the Bretton Woods system. At the time, much of the rest of the world was very upset with the U.S. for doing this, which prompted then Secretary of the Treasury John Connally to say, "The dollar may be our currency, but it's your problem." And it's my argument that those words have never been more true than they are today. I believe that not only is the dollar not on the verge of its imminent demise, but that a combination of technological innovation and legislation are the precursors to the reinforcement of the dollar as the global reserve currency. In other words, while the rest of the world may be discussing plans on how they're going to leave the system and storm the castle, the United States is actively increasing the size of the moat and building the tower walls higher than they ever have before. And we just wrote a 30-page paper titled Empire by Code, which lays this all out in more detail. But that's what this presentation today is going to be based on. This is all related to the Genius Act. If you haven't heard of it, this was signed into law a few months ago. And typically when I see the name of a new law that has been passed, my first reaction is to laugh because it's usually the exact opposite of what the name of the law implies. But not this time. Having thought about it for a long time, I think in this case, the name is actually appropriate because once you understand the possibilities that are laid out as a result, it really is genius. Now, after I tell you about how it works, you may think it's evil genius or Machiavellian genius, but I'll leave it to you guys to decide which is which, but I do think it is a very big deal. Famed military strategist Karl von Clausewitz once wrote, "I shall proceed from the simple to the complex, but in war, more than in any other subject, we must begin by looking at the nature of the whole. For here, more than anywhere else, the part and the whole must always be thought of together." And I think that's a perfect way to start this conversation and this presentation, because I don't think that this only applies to war. I think it also applies to money. And to understand either, one must study the whole, not just its fragments. So in the slides that follow, I'm going to talk about several different parts. The nature of money, the euro-dollar system, the SWIFT network, the Genius Act, and the subsequent rise of stablecoins. And while each of those sections, I could probably do an hour presentation on each, we just don't have time to do that today. But what is more important than each of those sections is how it is considered as an expression of the overall system. The details matter, but the overall structure matters even more. Because what is emerging is not just a new currency system, but in my opinion, a new form of control. And make no mistake, something seriously profound is shifting in the architecture of the global monetary system. Code and ledgers are no longer just symbols of rebellion against the state. They are now being co-opted by the state and becoming extensions of the state. And the very tools that were once imagined to escape central authority are now being absorbed by the most powerful monetary authority that's ever existed. And through these digital tokens that settle in real time and travel across borders without friction, the United States may be transforming the architecture of the monetary system itself. And from a financial perspective anyway, much of the story of the past century has been one of tension between state power and individual rights and individual choice, especially when it comes to monetary architecture. The Eurodollar system, which is a system of dollars that trades outside the United States, demonstrated that private markets can create money beyond the reach of U.S. national regulators. And Bitcoin proved that software alone could issue and verify value without the need for a central authority to do so. However, we believe that this private innovation and state power are converging into a single monetary system. US dollar stablecoins have the potential to fuse the borderless efficiency of crypto with the enforceability of state power. In other words, rather than the US being disrupted, we think the US is in the process of disrupting itself and subjugating everyone else. Where the SWIFT system gave partial control to the United States, a US dollar stablecoin system could give full design level control to the United States. To put it bluntly, we believe state-sponsored US dollar stablecoins could be as transformational to the global monetary system as leaving Bretton Woods and abandoning the gold standard was 50 years ago. So as a little bit of background, stablecoins are a type of cryptocurrency. The difference is that these currencies are not trying to design or provide a value of their own. They're linking the coin to something else that has value. In this case, we're talking about a US dollar stablecoin, but you could have a gold stablecoin, you could have a copper stablecoin, you could theoretically have a real estate stablecoin, but the stablecoins are a digital representation of another asset. And some are collateralized by currencies themselves. That's what we're talking about today, about US dollar. But many things could be done this way. Peter earlier was talking about a gold stablecoin. You could have its, a stablecoin that's also linked to another currency or another commodity. But with regard to US dollar stablecoins, some have highlighted the need for reserves by these issuers to create a new steady bid for short-term treasuries, and that this demand will help the Treasury fund its persistent deficits and at the short end of the curve while waiting for interest rates on the long end of the curve to fall lower. And while we agree that this is probably true at the margin, we think this is a rather small benefit to this new stablecoin system. And I think the focus of U.S. fiscal funding completely misses the real strategic value that the official U.S. dollar stablecoin could give to the United States. Beyond funding, we see that the real importance lies in extending U.S. monetary reach globally via digital code. To put it more clearly, the true significance of this system lies not in the marginal cost of funding for the government, but in the quiet transformation of money itself into a system of soft control on a global basis. One that is capable of extending the privileges of dollar sovereignty into every corner of the globe that has an internet connection and chooses to adopt this token rather than their local currency as money. But that then brings into a widely debated question, specifically, what is money? Now, if you guys were here last year, I gave an entire presentation on what is money. Many of us agreed that the definition that we liked the most was the most marketable commodity which extinguishes debt and that has been chosen by free market forces. Who likes this definition of money? Okay, handful of people. But then we also said in the real world, governments do exist. So while we would like it to be kind of this libertarian, utopian, free market chosen token, governments are going to throw their weight around. And since we don't actually live in this free market, money is ultimately what the government tells us it is. Or perhaps it is some combination of the two. And I have long argued that it's fine to have one's personal beliefs and what we would like to see, but it's extremely important to temper these personal beliefs with situational awareness. And if you're in an environment with a dominant local power, let's just use prison as an example, the biggest, toughest guy tells you that cigarettes are money. Who here is going to go up and lecture him on the powers of efficiencies and free market dynamics? Any takers? Yeah. Last year I said my favorite idea for a reality show was to have Peter Schiff go into prison and explain this to them, but I don't think Peter would like that. I certainly wouldn't want to do it either. But regardless of which camp you're in, I think money and power are inseparable. Napoleon, who knows a thing or two about power, had this to say about it. He said, there's only one thing in this world, and that is to keep acquiring money, power, and more power. All the rest is meaningless. Now, even if you or I happen to disagree with Napoleon on this, Napoleon was a pretty successful guy in his own right, and he knew a thing or two about power. And I would argue that governments do agree with him, even if you and I do not. In any case, I think money has this duality to it that reflects these two forces, the sovereign's claim for tribute and the market's choice of liquidity. But regardless of whether money is initially emerged as an expression of the free market or if it was created as a tool of the king, it's important to understand that in our world today, money has been co-opted by the powers that be into a form of control. The original matrix, as I refer to it. And it is this form of control that is extremely important to understand, especially as we move forward in time and as technology increases. Because the power of seigniorage is the greatest weapon that is handed to a sovereign. And the seigniorage, is the lack for a better word, is the power to print money. It's like holding the ring of power if you're a J.R.R. Tolkien fan. And to have that ability on a global basis is the dream of every power-hungry politician that has ever walked the earth. Because global seigniorage grants the issue the power and influence over the entire world. Maybe not perfect control, but strong control. And while states may define units of account, markets will ultimately decide what instruments that they trust. And if local markets start to adopt a private or foreign form of money, the local state's authority begins to erode very quickly. Stablecoins have the potential to merge these two definitions, marrying market preference with sovereign backing and sovereign control. And this is where understanding of sovereignty comes into place. To be sovereign is ultimately to have ultimate power and to be beholden to no one. It's about absolute control, free of any influence whatsoever. Now, what this means is you cannot be sovereign if you are beholden to a money that you cannot control, because then you are subjugated to that form of money. Sovereignty in monetary terms is the capacity of a local government to issue, manage, and enforce a unit of account without being subject to an external force. Dependence on a money one cannot control equals at least partial subjugation. And as such, a globally adopted US dollar stablecoin would lead to a loss of credibility in local currencies and thus into a loss of absolute sovereignty for local domestic governments. We've seen this play out before. This is actually not new. And with the rise of the Eurodollar market post-World War II. These Eurodollars originated as offshore holdings of US dollar balances that were outside of US regulatory reach. But despite being outside of US regulatory reach, the rise of the market has allowed US policy to at least partially influence the global liquidity associated with the Eurodollar market, albeit not direct control. And as such, it has provided the US both a weapon that it can use, but also exposed a vulnerability to the United States. Because this market is, in essence, leverage without supervision and regulation. In 2022, the Bank of International Settlements put out a report detailing the explosion of the US dollar credit on a global basis that had been extended through this Eurodollar market, while highlighting an $80 trillion blind spot due to off-balance sheet FX swaps. And this is $80 trillion that the rest of the world owes to each other in US dollars. They do not owe it to the United States. This is credit that has been extended outside the United States by an outside entity to another outside entity. And while these numbers are astronomical, the important thing to take away is that this is a non-US issue. It affects the United States, but this is, again, amongst the rest of the world. In other words, their monetary sovereignty, because this is all based on US dollars, is already in question. Furthermore, the United States has been making efforts to bring this Eurodollar monster, which nobody can currently control, to the extent possible, back under US control. For example, LIBOR, which stands for the London Interbank Offered Rate, began back in the 60s as a way for London banks to standardize the interest rate for the loans and the credit that was extended in this euro-dollar market. It provided a common benchmark to price trillions of global loans, bonds, and derivatives. And over time, LIBOR kind of became the global heartbeat of global finance, but it was based in London. And after decades of reliance on LIBOR, U.S. regulators finally moved to replace it and move it back under direct U.S. control. They introduced SOFR, which stands for Secured Overnight Financing Rate, based on actual transactions in the U.S. Treasury repo market rather than a group of bankers in London. And by shifting the global benchmark for dollar credit from London back to the United States, the U.S. effectively brought dollar rate setting back under its own regulatory and sovereign control. This LIBOR to SOFR transition symbolizes Washington's effort to reclaim control over this large euro-dollar market. In order to understand the traditional euro-dollar's rails or plumbing through which all of these euro-dollar transactions would take place, we first need to understand the SWIFT system. SWIFT was created in the 1970s by a consortium of these European banks that were extending U.S. dollar credit to each other as a way to replace slow and error-prone telex messages with a secure, standardized global settlement system that could be done kind of on a daily basis and across borders. It doesn't actually move the money itself. What it does is it helps these banks come to a standardized way to settle the trillions of dollars of transactions in U.S. dollars that take place outside the United States on a daily basis. And over time, this SWIFT system kind of became the central nervous system of global finance, giving regulators, especially those in the United States, unmatched visibility and leverage over international money flows. Now, again, they had some control and some leverage, but not perfect control and not perfect leverage. And as anybody who ever has had a position of control knows, you want to have perfect control. You don't like having the ability for things to go out of your control. And so post 9/11, the U.S. leveraged this SWIFT system via the Terrorist Finance Tracking Program. And this is a great book. If anybody's interested in this topic, I would recommend reading this book. This is written by a guy named Juan Zarate, who was a Treasury employee and worked in this Terrorist Finance Tracking Program. But in this system, the U.S. Treasury weaponized compliance and sanctions to help achieve U.S. geopolitical objectives. But SWIFT still remains a European system. And while the U.S. can influence it, it does not fully control it. And again, to be truly sovereign, one must be in full control. U.S. dollar stablecoins could potentially replace U.S. dependence on SWIFT with the development of a new programmable, and very transparent American system of monetary rails or plumbing, however you would like to categorize that. So a U.S. dollar stablecoin has the ability to extend the U.S. dollar's reach invisibly, replacing euro-dollar plumbing with newly developed code. The possibility that a widely adopted U.S. dollar stablecoin could be used to accelerate dollarization of non-U.S. economies raises existential questions about what that non-U.S. country's national monetary autonomy really is. And with the ability to take aim at various dimensions of financial sovereignty, we do not believe it would be hyperbole to name a U.S. dollar stablecoin as a stealth weapon of empire. As adoption of U.S. dollar stablecoins spreads, domestic control weakens where these U.S. dollar stablecoins circulate. And using money as a weapon is not some hypothetical concept that I just made up in my office one day. The United States military and wider governmental apparatus have long recognized money as an operational instrument in conflict and stabilization operations. Doctrinal handbooks and commander's guides produced for operations in Iraq and Afghanistan formalized the idea of money as a tool to shape local economies, influence populations, and achieve tactical and strategic objectives. Stablecoins have the potential to become the digital heirs of that doctrine, projection through liquidity rather than military force. If a local economy comes to price goods, pay wages, and denominate contracts in a foreign-pegged token, the practical authority of that domestic state is vastly diminished. The process by which a stablecoin steals that control is incremental and market-driven. It's not necessarily violent or overt. First, the token gains traction because it offers lower friction, faster settlement, cheaper cross-border transfers, and easier access to global markets. Firms that export or import or hire and find commercial logic in aligning with the most conventional settlement medium. Payrolls become denominated in the token, reserves are maintained in that token, and fiscal policies, and private contracts start to get denominated in that token. As a result, the domestic central bank then faces a stark choice. It can try to restore confidence in the local currency, either by new regulations or painful fiscal policies or even capital controls. Or it can accept the slow erosion of monetary sovereignty as private foreign denominated stablecoins become the new practical means of exchange. And the military lineage of money as a weapon matters because it demonstrates the conceptual continuity between on-the-ground financial operations and the broader idea of money as a use as leverage in geopolitics. And that brings us back to the Genius Act. In 2023, members of the U.S. Congress introduced the Guaranteeing Reserves of Uniquely Issued Stablecoins Act as a concept. To many observers, even me at the time, I totally missed it at the time. It's only subsequently when I did a bunch of research on it that it started to become more clear. But initially, it looked like a technical regulatory effort meant to protect consumers and strengthen oversight. In reality, we believe it to be something much more ambitious. We think it's an attempt to fold the digital dollar frontier into a formal structure of U.S. monetary power. We believe the Genius Act is Washington's preemptive move to make sure that a second Eurodollar system that would develop in the crypto cyberspace would fall under their jurisdiction and their control. And to that end, the Genius Act requires stablecoins hold full reserves in cash or short-term treasuries, which fall under the U.S. supervision. It prevents a second Eurodollar problem by keeping digital dollars under U.S. financial control and jurisdiction. And it transforms private software innovation into a state-sanctioned monetary system. And it codifies monetary hegemony through regulation and private consent rather than through military conquest. By drawing digital dollars back within the perimeter of U.S. jurisdiction, the Act ensures that even as technology evolves, the fundamental architecture of monetary hierarchy remains intact and favors the U.S. dollar versus other fiat. And this is where the debate over stablecoin is not merely technical or regulatory. It's about the future of monetary sovereignty and the distribution of economic power on a global basis. The end user does not need to understand monetary authority to use this. They only need to see that their digital dollar that they can hold on their phone maintains better value and does not lose value overnight the way their local currency does. And despite the popular de-dollarization myth that is often, put out as popular narrative, evidence clearly shows a world still very hungry to hold U.S. dollar balances. Stablecoins can also provide dollar access to globally unbanked and inflation-scarred populations. Dollars already circulate widely in nations like Argentina, Turkey, Nigeria, et cetera, And 99% of stablecoins that are already in issuance are already tied to the United States dollar. And history shows currencies that begin to fail are often precede the political failure of the government in those jurisdictions as well. So digital stablecoins give populations in these other foreign jurisdictions that have unstable currencies an instant escape valve from these local currencies. In the old days, they had to take their physical domestic currency and go down to some local market or money changer and find US dollars on the black market. And when they would have to do that, not only would they be selling their dramatically devalued local currencies, but the spread they would have to pay to get dollars was pretty wide. Now they can just use their phone, if they have an internet connection, push a button and hold a US dollar balance. And there's very little that their government can do to stop them. So this has the potential to accelerate the loss of local sovereignty if and when these currency crises break out. So essentially, this is why the geopolitical implications of US dollar stablecoins exceed their financial ones. And this is why I don't think funding of the US government is the primary benefit from these existing. The rise of programmable dollar-based tokens is not a question of technology or convenience. It's the creation of a parallel monetary order that extends American influence through voluntary adoption. By meeting the world's hunger for a more stable value than their local currency, The United States can project power more effectively than they could through sanctions or military deployment. Now, there are, of course, going to be arguments against this view, and that they will say it will never work. And the reality is, though, is every strategic innovation has faced a chorus of doubt. The same has been true for every major transformation in the global monetary order of the past. And critics of a US dollar stablecoin framework argue that such a system cannot endure. The de-dollarization, foreign competition, and investor apathy will prevent this from spreading. And I think these arguments are worth addressing directly, not because they're without merit, but because they misunderstand what kind of contest this really is. This is not a struggle between fiat and hard money. It's not a competition between dollars and gold. It's a competition between fiat and fiat, and one of them has already won this battle. Much has been written about de-dollarization, from oil contracts settled in yuan to regional payments promoted by the BRICS countries. The narrative suggests that the world is moving away from the dollar. And while the efforts do exist, these efforts have largely fallen short of any meaningful substitution on any kind of scale. Trade and reserves remain overwhelmingly denominated in dollars because no other fiat offers comparable liquidity, depth, and legal clarity. Even those nations seeking independence from the system still continue to price their wealth in it. And a US dollar stablecoin does not weaken this US dollar structure, it reinforces it. Another objection is that the stablecoins will not be able to attract sustained demand because by law they pay no interest. Why would you hold on to something that doesn't give you a dividend? This argument mistakes the nature of the instrument. Stablecoins are not investments, they're liquidity tools. Most of the world's money does not earn yield. Most of it sits in cash or checking accounts or even some kind of a mobile form of money. Their function is utility. Their function is not return. And more importantly, stablecoins exist within the current fiat hierarchy. Their users are not choosing between a stablecoin and a treasury bond or a piece of gold. They're choosing between a stablecoin and a local currency that often loses double digits of value every year. In that comparison, a zero-yield dollar token to many foreigners is seen as a high-yield asset, and stablecoins offer efficiency that regular dollars do not. Another argument against stablecoins centers around gold, and that central banks, they have indeed been buying gold, right? And the share of reserves sitting in gold have risen, while the amount of reserves sitting in fixed income and treasuries has fallen. Now, we're strong believers in gold, and we believe the cornerstone of every portfolio, whether you're an individual or your institution, should be in gold. But that's a completely different argument. Again, US dollar stablecoins are not competing against perfection. They're competing against other fiat that is dramatically flawed. And a final critique offers that other nations will issue their own stablecoins and thereby erode US dominance. China's digital yuan, the European euro, digital euro, and numerous smaller CBD projects have all been announced, to varying degrees over the last 5 or 10 years. Yet the emergence of a competitor does not equal parity. The global currency hierarchy is not flat, it is gravitational, and it strongly favors the US dollar. And a currency's digital form cannot transcend the strength or weakness of the economy or fiat currency that is behind it. This remains a fiat versus fiat contest, and most fiat systems outside the United States still rely on dollar-denominated assets for credibility. A digital yuan is still a yuan subject to Beijing's capital controls. A digital euro is still a euro bound by the political compromise of the European Union. A US dollar stablecoin, by contrast, would be anchored to the deepest collateral market in the world and the most credible legal framework in finance. It is also already directly linked to the eurodollar market, through which many of these countries already have exposure, which the world chose as its international form of money decades ago, much to many people's chagrin. Competing stablecoins may circle regionally. I would expect them to, and I would expect countries to kind of fight back. But they will orbit the same dominant center of the US dollar as the current fiat world does. Not to mention the fact that 99% of all stablecoins are already anchored to the US dollar. In summary, all 4 of the objections against the US dollar stablecoin success kind of share the same blind spot. They assume that stablecoins must compete against perfection rather than against other weakness. The US dollar is not strong because it never depreciates. It's strong because every other fiat falls even more. And this is the real foundation of fiat hierarchy, a system where power is relative. It's not absolute. And stablecoins extend that relatively into the digital form, which is quicker, faster, cheaper, and more efficient. And finally, where we Americans see the US dollar as flawed and inflationary, much of the rest of the world sees it as strong and stable. In summary, stablecoins are a technological innovation with profound economic uses. They fuse the logic of the Eurodollar market with the precision of software. The Eurodollar network extended America's influence by allowing offshore banks to create US dollar liabilities while still anchoring global finance to the dollar's foundation. As stablecoins are adopted, foreign governments can set domestic interest rates, put up new policies in order to try to keep their local currency from losing traction. But as this happens, the demand will flow elsewhere. Tax collection, seigniorage, and liquidity provisions, all the levers of modern statecraft, begin to slip away. And history has shown that any transitions are rarely reversible once the public abandons the national unit of account. And this is the quiet genius of the new system. Like the Eurodollar system, it's spread voluntarily. No army demanded its use, no fleet protects it, and yet it advances faster than any physical empire in history could. And the best weapon that any country has is the one that never has to be physically deployed. And we think that could actually be exactly what a US dollar stablecoin provides. So if you like what I've talked about today, or if you don't like what I've talked about today and you want to find out why I'm wrong on all of this stuff, you can subscribe to our research on Substack. If you go to research.santiagocapital.com, we write and talk about this stuff, this type of stuff quite often. And here is a QR code for the written report that goes with the speech that I gave today. So if you're not interested in a full subscription, but you want just the report, you can scan that and you can take you to our website. And I'll be around all afternoon, and if anybody wants to discuss or ask questions. Thank you for listening.
Okay, guys, I hope you enjoyed that. And that's it for this week. We'll be back again next week. I hope you all have a good one, and we'll catch up then.